For the next conversation, the Disruptors, from Moonshots to the next big thing, please welcome moderator Alex Konrad, senior editor, Forbes, and panelist Shardul Shah, partner, Index Ventures. Latif Peracha, general partner, M13, and Nihal Mehta, co-founder and general partner, Eniac Ventures.
I feel sorry for Shardul. He did so well on our Midas list this year, and yet we gave him a new firm name, so we're going to update that.
News today.
Yeah, you're the top-ranked investor at Index Ventures.
Ventures, the one and only.
Well, thank you so much for joining us. We have three awesome investors here from very different, I think, style VC firms, but all pretty established firms at this point. I promise we're going to have this be an organic conversation, but maybe we can just start with the two sentences on your stage of investing, kind of your focus area, because it'll just give people context. So Nihal, I'll start with you. Can you just tell everyone what your focus is at Eniac?
Sure. Thanks, Alex, for having us. Good afternoon, everybody. Co-founder of Eniac Ventures. We're here in New York City. We lead pre-seed and seed rounds in generalist tech startups. So these days, AI is a part of everything, but we've been investing in machine learning since the beginning of the firm, which was 2009.
Hi, everyone. Latif Peracha. I'm a partner at M13. We're a Series A fund based between Los Angeles and New York. We invest in software companies. Historically, we've focused on fintech, healthcare, commerce, and the future of work. We'll also go into where our curiosities take us, but really also focus on adding a tremendous amount of operational support to our companies.
Shardul, Index Ventures. We're a global multi-stage firm. Presence in San Francisco, London, and now New York. I moved here about 2 years ago. I focus on B2B enterprise companies, mostly infrastructure and security, but our firm invests across all domains, all geographies, at all stages.
So aren't you guys all lying and you're really just AI investors at this point? I mean, what is or isn't AI? And it's been a big topic already today, whether it was the CEO of Carlyle, it was Vinod Khosla. Where is AI relevant to your firm, Nihal, or not?
Yeah, I mean, I think even if it's not a native AI startup, meaning AI is the actual business, every startup we look at essentially uses AI for some sort of efficiency. So even if it's a consumer brand, they're using AI to make their customer service teams a lot more efficient. And so at the end of the day, we look at it as an incredible efficiency multiplier, cost reducer, so that these teams have a lot more incredible leverage and they're a lot more capital efficient.
Latif, please say you're not an AI investor.
Well, we certainly are an AI investor, but not only an AI investor. I mean, I think if you look at AI, it's a bit like saying you're a mobile investor back in 2009, 10, 11. Like, yes, that was true when it started, but clearly it permeated everything. But we not only focus on AI, so we actually have a big thesis on crypto and blockchains and believe, despite the ups and downs and some of the polarization of that industry, there's tremendous innovation, and given so many VCs are focused on AI only, we do think there's going to be tremendous opportunities for returns, but also for real significant technical innovation around crypto and blockchains.
Shardul, obviously, we've covered, we put Wiz on the cover of Forbes last year, one of your investments. You also made the Midas list for Datadog. Are those also kind of AI companies at this point? Are you an AI investor too?
We're not AI investors.
All right.
We focus on people, and it turns out at different moments in different cycles, people might gravitate towards certain themes. But this year, maybe not like 2021, has been super active for us. And if I look at the number of decisions we've made at the investment committee level, half are outside of what I think each of us would describe as AI. Fintech, gaming, healthcare, all have been interesting and thriving areas for entrepreneurs. And so when I think back to Wiz, when we invested, it was on my birthday before the team had a PowerPoint presentation. When we invested in Datadog and led the Series A, it was $10,000 in revenue. Like it's not really a thematic investment as much as it is of a diagnosis of entrepreneurs that might go on to build a really compelling business.
Interesting. But before we keep going, I'm just curious, by show of hands, how many people in the audience work in venture capital? Raise your hand if you work in VC. All right, so it's a smattering, but I'd say most people do not work in VC. So let's zoom out a little. Like, how much is this AI conversation dominating or creating an outlier around the VC conversation? Like, if we were to strip out AI, is this a good venture environment? Is the money flowing, Nihal, in your view?
Yeah, we think it's an absolutely amazing environment. I think largely because there hasn't been, significant liquidity events since 2021. I think a lot of managers have not been able to raise new funds. And so there's a lot less, at least we feel like at the seed stage, there's a lot less supply of early stage capital. And so that leads to a lot less competition.
So it's a good environment because it's a worse environment? It's like better for you?
It's a better environment because it's a shittier environment.
Okay.
That's correct.
Right, okay. Would you agree, Latif?
Yeah, I mean, I don't think you can say without AI, that's sort of so hypothetical and not really grounded in what's happening. Like the whole point of venture capital is to invest in breakthrough emerging technologies.
Well, what I mean by that is, we see numbers like investment dollars by city. And there could be $1 billion funding round for one AI company in a city, and the city says we had $1.1 billion go into startups this quarter. But that really means 100 million for everyone else, and then $1 billion for this one outlier company. Does that mean that ecosystem is doing well? So I was just wondering if the conversation is being skewed by the exuberance in that one area.
Yeah, it is, but I would say that's actually a good thing. I mean, if you look at the macro environment, and you look at, I know there's a lot of probably macro people in the room, and so I don't want to speak out of turn, but where rates are and everything else, I actually think AI as a trend has huge implications, can really be the actual reducer of inflation in a way that isn't I'm going on a bit of a tangent here, but it's not Jerome Powell, it's actually through technology. So I think that's a massive trend that is very optimistic and one that we should embrace. So there's probably some noise in the data, city by city, but overall, I think what AI is enabling both at macro level, top down and then bottoms up in the things that we're investing in is incredibly important.
Yeah, I disagree with respect. Outside of AI, we're seeing extreme competition. Again, in gaming, in fintech, from Israel to Seattle to Germany, France, name your geography, name your stage, we're seeing extreme competition. Outside of AI, Wiz, which you alluded to, just announced $1 billion fundraising a couple months ago. And so there's an enormous amount of capital available for the best companies in large categories. And I think in difficult periods like the one we're in from a macroeconomic and geopolitical standpoint, you find entrepreneurs who are really on a mission, who are put on earth to solve a problem. So I think it's a wonderful time for entrepreneurs. It's a beautiful time to be an investor, despite what we see as extreme competition.
Yeah, I'm going to agree with Shardul on the point of, I think right now the best founders know it's almost one of the best times to build, maybe since the early 2000s, in the sense of all of the different platform shifts that are happening, the access to capital, the capital efficiencies. And we're seeing a growing number of, we call them human unicorn founders, but serial founders who have built multi-billion-dollar market caps that are all of a sudden, building again right now.
Latif, is there an industry outside of AI that you see just really ripping, or there's just a ton of momentum among a bunch of companies, maybe not just one or two companies, or is there an area that excites you the most?
I'll double down on my crypto comment earlier. I think we're seeing tremendous innovation around actually gaming is a huge area of focus where you're seeing actually the ability for end users to actually own their gaming assets and move them between games. And there's a lot of activity we're seeing, and that's both here in the US, a lot of it is also in Europe. So crypto gaming, and then also I think payments is a huge area of focus. There's this kind of narrative of, well, what has crypto done? And if you actually look at the history, stable coins, which, if you take a very ethnocentric approach and you say here in America, like, yeah, we don't need to use stable coins, but if you're in a high inflation environment like a Turkey or Venezuela or Lebanon, pick your place, they're incredibly important. And so payments is just, what makes the world go round, and I think crypto has a huge role to play there. I saw some data that showed that in Turkey, 5% of their GDP is transacted in stablecoins. So you just think about how long they've been around. That's a tremendous, I think, a tremendous data point that there's something here that's really working. So we look at payments. We're investors in a company called Code from a very prominent founder who is trying to finally solve micropayments. Why should you have to pay whatever to Forbes on a daily basis or monthly basis when I can pay for Alex's article on a one-off basis and pay you instantly? Like, there's all these things that should happen that just don't happen in the world that I think crypto can solve. So we're spending a lot of time there. And as a generalist fund, there's these crypto-focused funds, and they've done, great. But as a generalist fund, we think it has a huge role to play within a portfolio of companies that also focus on AI and other areas.
That's interesting. I mean, so Shardul, like, when you have a big company like a Datadog or a Wiz in, data observability and cybersecurity, does that mean that sector is like covered for you? Because you see this company break out years after you studied the category, you made the investment, or do you try to double down where you look for then more companies in an area where you've had success?
Yeah, look, I'll answer it in two ways. So Datadog, for those of you that don't know, it's a public company. It's $40 billion plus market cap. I've served on the board for over a decade. And so I think my challenge with Datadog is very human. I formed a lot of bias, right? The opinions I hold around the product that's required to serve a set of enterprises is really challenging to unwind when I meet a net new entrepreneur. I've tried to leverage that learning and that bias as I approach a new company like Wiz, which is only 4 years old. It's the fastest growing software company of all time. But I've tried to be really open-minded about what else can exist in different ways to serve the needs of customers. So security, in my view, is an approximation to crypto in terms of a rising tide that has facilitated a lot of value and value exchange in our industry. If you kind of rewind the clock 10 years ago, there were probably 4 public security companies of any relevant scale. At that time, Palo Alto Networks had $5 billion of total market cap. Today, they have $5 billion of gross profit, and in February, they touched $100 billion of market cap. CrowdStrike is a $70 billion company. Zscaler, Cloudflare, Checkpoint are all $15 billion plus businesses. So security has exploded, and I think it would be really naive and limiting as an investor to view that Wiz has conquered them all. I think within cloud itself, there are opportunities around identity and data. Outside of products, I think there's a huge opportunity for insurance. I serve on the board of a company called Coalition, which serves a different segment of the market, as well as outsourced services, and I serve on the board of a company called Expel in that area too.
I think you make an interesting point on like pattern recognition. So you had an investment that obviously was very successful, and trying to there's a trend of like if you've done enough deals, you have enough pattern recognition, and actually I think that's a fairly dangerous framework to fall into, because things that were successful in the past are maybe not going to be successful in the future in terms of a type of profile of person or industry. So I think to your point, I think it's tough to do, but you have to like basically unwind that and try to get the entrepreneur to show you a vision of the future, and then just really kind of back that vision, kind of get an insight that gets you excited.
It's true. It's so hard to listen. That's basically the job.
Nihal, you were saying backstage that, correct me if I'm wrong, you were looking at Adtech again, which I find interesting because there are some investors out there and founders who were in sort of the big Adtech boom of maybe, at this point, 15 to 10 years ago, and they, at least for a while, said never again. Like, it's played out, it's miserable, I don't want to do it. Why go back? Is that a contrarian take?
Yeah, I think their recovery took many years. They had to go through their own kind of personal journeys to want to build Adtech again. But I think we're definitely really excited about Adtech. I think there's I was mentioning kind of 3 platform shifts that we look at right now. One is obviously driven by AI. The other is in streaming and connected TV. And the third is in mixed reality. Whether or not the Apple Vision Pro was a flop or not, there's significant investment both from Apple and Meta into that entire medium as a future of human-machine interaction. And so with all these platform shifts, they're going to require and mandate monetization layers. And so what's interesting, at least what we've seen in a few cycles, it's always kind of in and around the same founders. The founders that built the Web 1.0 and Web 2.0 great ad tech companies, or the mobile 1.0 great ad tech companies are now building again. And so actually, I'd say 3 of my last kind of 5 investments have been these ad tech founders that are now running towards these new platforms.
It's interesting. I feel like venture is supposed to be kind of a contrarian business where you want to back the companies before the category becomes obvious. But we have seen sort of a collapse of time cycles where we can have like micro cycles of hype or mini hypes. Like maybe we're back into a crypto more optimistic cycle now after like a couple of years of negativity. So if all of that shrinks, where becomes the alpha for you guys, or the place where you can maybe get a leg up on other smart people trying to back similar companies? Is it mostly an access game for you guys? Is it mostly a conviction game, a discovery game? Maybe each of you can answer that. Latif, we could start with you.
Well, on hype cycles, we spend a lot of time at the firm talking about them. In our annual meetings, we put them up and we kind of show where various trends are. Crypto is a unique hype cycle because it basically, I can't explain why, but it does this thing where it actually repeats over and over. So you go through the peak of inflated expectations, the trough of disillusionment, and then you come back the other side. And usually it happens once in a wave for technology, but in crypto it just kind of does one of these, which as an investor actually makes it interesting because you can kind of see where we are in a cycle and invest in that cycle. But I think each of these technologies have that, and they play a huge role in capital formation and talent formation, and so it's pretty critical. To your point on like how we think about the edge or where to go, I'm increasingly of the view that we used to debate TAM at the total addressable market at the firm, and I really just moved away from that. I think it's a bit of a dangerous framework. So I'm actually looking for net new markets or net new breakthroughs that can create a market. So for example, we invested in a company in the beginning of 21 called Form, which is a healthcare company in the obesity management space. This was long before GLP-1s were a thing, but the founder put up a slide and he said, hey, look, half of America is obese, and 10 years ago, the medical association basically classified it as a disease. So it's going to spawn innovation in pharma, it's going to spawn innovation in medical schools. And because of that, if you look at chronic diseases, they go from, typically they kind of asymptote and they scale at like 65% treatment rates. In obesity, it was sub 1%. So you had this massive kind of new market that was going to be created, and I saw the founder's background, and you quickly cut the check, and so that's, we think, a $500 billion new market, and we expect our company to be one of the market leaders there. So that example is just to show, I think, if you can find a new market and ride that wave, ride that tailwind, that's what we're looking for.
But then is it finding the deal, winning the deal, or having the guts to do the deal that your peers are passing on? Like which is the most important? Well,
kind of sequential. You can't win it if you can't find it.
Yeah.
But and to the point of, wow, this deal no one else is looking at, I think the market is very competitive, and so it's very hard for that to be the case. I think it's a combination of those things, and then, if you're on the Midas list, that clearly, or you've got great companies, that clearly it's a point that founders really will look to, or whatever your track record is, that's important. What your firm value add is very important. So we spend a lot of time with our propulsion model, which my partner Christine is here, who runs brand for us, and we have other partners who really come hands-on and really focus on supporting the company. So I think it's a combination of those things. And in the case of Form, I got on a plane on a Sunday in COVID with my mask on and sat in a very depressing room at Logan and gave the guy a term sheet. And I can promise you there was no one else doing that. So it's all those things that I think add up to hopefully finding the right companies.
Yeah, I think founders want brand, value add, speed, and price. Like, that's the menu. I'm very grateful to be on the Midas list, but I think what's cooler is Index. There's no firm that has more partners than Index on the list, which I think speaks to the effort we've put in over 20 years to build our brand. From my perspective, when I'm meeting an entrepreneur, I'm looking for, and it's a craft, so this is evolving, but I'm looking for imagination, operational excellence, and high-quality decision-making. And I spend an enormous amount of time trying to get to the essence of an entrepreneur in those three dimensions. And it turns out it's rare for me to find, which maybe means I have to like hunt where I'm not competing with you or collaborating with you on. But when I find that, I can move extremely fast and aggressively.
I guess another way to think about it is like Nihal at Eniac, are you more upset when you saw a deal that turned out to maybe be a big win and you guys just decided not to do it? Or would it be worse if you didn't see the deal at all? Like what would be the area where you would always want to improve there?
Yeah, it would definitely be worse if you didn't see the deal at all. You know, I think this game is, you have to be at the table. And it's okay to pass. I mean, you're gonna miss some good ones and you're gonna get some good ones. You know, we're fortunate to have a very large shadow portfolio. But we're also fortunate to have led seed in great companies like Attentive and Alloy and Brightwheel and Ghost. To your previous question, you know, Shardul, you mentioned kind of a menu of things. I think the founder is really most excited about one, which is conviction. And almost the earliest conviction. And I think when an investor, you know, looks in their eyes and says, I totally believe in you, and I know the market's gonna change and your product's gonna change, but I'm with you 110%. That actual like emotional engagement goes all the way up. We say our most important KPI is being at the IPO party. And at the IPO party, that's the one thing that the founder remembers, is that you were the first person that believed in me. And by the way, that business since that first pre-seed check has changed a dozen times, but that founder hasn't. And that memory hasn't changed. So I think that conviction is probably one of the most important things.
Speaking of the IPO party, we would see a lot more fresh faces on the Midas list if more of these companies were going public and exiting. Especially here in New York, I would love to see another Datadog. I'd love to see more companies like MongoDB go public. Are you guys optimistic that the sort of pace will pick up? We saw Reddit and a couple sort of smaller, relatively IPOs happen, but it hasn't noticeably led to a stampede of public exits. And that's ultimately what the game is often about, right? I assume your LPs would love to see liquidity or more. What's kind of your sense on the state of play there, Shardul?
Yeah, it's a super important question. So one, in terms of New York, I'm extremely optimistic. One, there's a next generation of talent that's creating companies because they've witnessed what great success looks like because of companies like Datadog and Mongo. Second, New York, unlike the Bay Area, about 25–30% of Series A's in New York are healthcare. There's a lot of institutions, there's proximity to payers, obviously a huge patient population on the East Coast that facilitates a really interesting ecosystem, and we're seeing some tremendous companies that are getting to real scale in New York. And third, we think New York is the destination for any European entrepreneur building a B2B business. So in the past, I would say, again, just 5 years ago, it was more standard for French, German, Israeli entrepreneurs to move to San Francisco as they built out the commercial part of their business. Today, 90% moved to New York. And so that combination, to me, gives a lot of optimism as to why we're going to see a great crop of companies go public, ultimately in New York.
But anyone else want to take a stab at, is that happening soon? Because I feel like we've been playing a wait and see game for some time now.
I think there's probably greater experts in the room, but tech multiples are directly correlated to interest rates, inversely correlated to interest rates. And so I think as soon as we start that coming down, multiples should expand, and that should hopefully provide an opening window for IPOs. I mean, we have a bunch that are ready to go. I'm sure everybody here does. So I think as soon as that window is open, knock on wood, early next year, let's see, it'll be good, good liquidity and good for tech. The IPO window should be wide open. Hopefully.
Also, given the regulators' kind of strong chokehold on M&A, for all of us to return capital to our investors, the IPO market is almost increasingly important as a tool.
And maybe like the small mid-cap as well is going to be really exciting, right? Reddit is kind of showed that these valuations can sustain in the retail environment. And I feel like there's dozens of these companies ready to go in New York that are kind of like 3 to 10 billion market cap.
But obviously, you guys wouldn't be on this stage if you weren't at firms where your LPs are most likely pretty content, pretty happy to wait things out and sort of reap these big benefits later. When you're talking to your peers more broadly, is the venture industry under pressure to be delivering more liquidity soon to these LPs? Like if there are endowments or family offices here in the audience, and maybe they're in a portfolio that isn't just you guys, should they be impatient? Should they be saying, okay, we need the asset class to start delivering returns? Or what's kind of the temperature among your cohort right now?
The feeling I have is we were really disciplined in creating liquidity in 2020, 2021. And I think our LPs really appreciate and respect that discipline. And so we have really patient capital that supports us, that we don't take for granted at all. I think when I think about our LPs and their position, when there was free money, right, they invested more in high-risk asset classes. And what happened was basically the proportion of their portfolios changed in a couple of years. And one element is fixed, the other element is not. And so I think you have to just revisit what your capital allocation is across different asset classes versus what ought to have been kind of a view on the length and horizon you usually appreciate with private capital like ourselves.
Yeah, we put out a paper recently called the CIO Approach to Venture, which I think there is an opportunity given these cycles are so long and where we are with liquidity. Our LPs certainly would like it. I think you got to get creative in the later stages of even in the private markets to understand like how can you potentially return some capital while maintaining a healthy position for that ultimate exit. And we've given a lot of thought to that, but I think there's an opportunity there to do something like that.
We were also fortunate at Eniac in 2021 to take some chips off the table. I think as a seed investor, it's a little bit easier to do. We're no longer a director on the board. It's not a negative signal. It's almost understood that at the Series C or D at the $1 billion market cap, we will, sell some of our shares in a secondary environment. But we're also fortunate that our LPs are very patient. The majority of our LPs, we just launched Fund 6, are nonprofit, mission-driven. So they're in it for the long haul. At Seed, it's a very long haul. We say there's a minimum 7-year feedback loop. So our decision at our IC today will know if it was a good decision in 7 years.
I asked my editors to give me a 7-year feedback loop too.
Nice.
Doesn't work then.
It's a unique asset class. Basically, you tell someone, I got 10, I'm going to invest in 10 things, 7 are going to go to 0, and the other 3 are going to work out, trust me. And that's kind of what we
Talk
do.
to my boss, yeah. So in a way to kind of bring this back to the beginning, to sort of put a bow on this, when you're thinking about those companies that will be the big fund returner, the big moonshot winner, is there a skill or a trait in the founders or the CEOs that you guys are really looking for right now, or encouraging founders to invest in? For anyone in the audience who's like thinking about what it takes to be the next great company, what's the first thing that comes to mind, Nihal?
Well, going back to AI, I think a lot of the startups we look at today have 50, 60% plus AI-generated code. Many of them don't have a co-founding CTO. And these will be the next $1 billion, I think, unicorns of our industry. And so what's really important there is that the founder has a really good sense of domain and go-to-market. I think more than before.
Would you agree, Latif?
Yeah, I would agree. I spent a lot of time thinking about like the profile of the person, and I just think like pure obsession with that like problem or that product, I think is the most important thing. Like if you're going to map out, you're like a consultant, I'm going to map out the market and say, there's an opportunity here, I'm going to go after that, I won't invest in that. I think that's just, it's too hard. So I was on the board of Ring, and I would say Jamie Siminoff was obsessed with home security in a way that was very unique, and that was what got me there. But
Shardul, are you still looking for like technical background founders, or does that evolve, or what's the trait that you look for the most to find the next, Asaf from Wiz or Olivier from Datadog?
Yeah, AI in the enterprise, one of the top 3 use cases is code generation. So basically co-pilots or different approaches to automate software development. This has become a very competitive market because Microsoft has raced to 100 million of recurring revenue in less than 18 months. Almost every single week through the beginning of this year, a new company has been formed or funded in the area. And so we had a global effort in order to take a view on the market. And to your point, we started with a view of what is the makeup of the team. Part of it was the go-to-market muscle to go against Microsoft, which is obviously a 10-ton gorilla or maybe even bigger. Second was a sense of pragmatism, or I think what you described as domain expertise. I think you don't just need AI researchers who are doing kind of science projects, but you need a pragmatic approach to AI to utilize the best-in-class software and take advantage of that with a research lens in mind. And third, I was looking for specific product acumen that could deliver value to individuals, developers, teams, as well as an organization, which is a much more sophisticated approach to bringing a product to bear. And so in studying, again, this market opportunity that had dozens of startups, there's one team, which is augment computing. There's one team that we found that made up the mix. And to Alex's point, kind of backstage, every other company has raised at $1 billion or $2 billion, and every week, like, the number goes up because there's so much enthusiasm for the market opportunity. And I think when you have conviction in a market opportunity, conviction in a team, you can actually pay some outrageous prices.
Well, the conviction has paid off for you guys so far, so we look forward to seeing what you back next. Thank you so much for the insights, everyone.